Hello, everyone. Thank you for joining us for episode 17 of the Business and Bites podcast. Today, we're going to go over avoiding pitfalls in finance with our CPA expert, David Rodriguez. How you doing, David?
Hello, how's it going, guys?
It's going good. It's going good. Also here with my co-host, John Hansman. How's it going up there, John? How's the weather in Washington?
It just made a turn for the worse. We were in the 70s and 80s, and then all of a sudden Washington decided to do what Washington does and allow the clouds to come back in. So we're heading east this week. So it's going to be a little sunnier where we're going, hopefully.
Cool. Well, started raining down here a little bit today, but it's always hot and humid in Florida. Actually,
It's a warm rain.
David is also in South Florida with us.
Yep, good old Miami.
All right, so today we got a good episode for you guys. We're going to be talking about some financial pitfalls to avoid, how to navigate things when you're registering your LLC and when you have your LLC, and common mistakes that small business owners make and medium business owners. Why don't we, David, let you go ahead and introduce yourself again. And if you can tell the people kind of your background and, how you got into accounting and why we should even listen to your advice.
Perfect. So going, guys, my name's David Rodriguez. I'm a CPA. I'm the founder of Rodriguez Advisors LLC. I kind of got into accounting basically back then when it was mostly in 2008 when the bubble burst and the economy, especially the real estate market, wasn't so very. It wasn't really doing that well. And originally, I wanted to become an attorney, but I had an internship at the state attorney's office, and then it didn't really fill my cup of tea. Then I took an accounting course, and then I realized that it is so necessary and important, like the field and the profession of accounting, that no matter if the economy is doing good or bad, or whatever the case may be, it's supremely mandatory in this market, in this world. It's whether you have to file your tax return with the Internal Revenue Service or with the state tax authorities, or if you even have to file your 10K or your 10Q with the Securities Exchange Commission. It's a big requirement. So basically, I got into accounting from there, did my undergrad, and then I got an opportunity to work at PricewaterhouseCoopers. They're one of the big four accounting firms. Their acronym is PwC, which that's what they're more known for nowadays. And I lived in McLean, Virginia for a few years, from 2012 to 2015. Then my daughter was born, and we missed being close to family, so we moved back down to Miami. And then I worked for one of the competitors, which is Deloitte from PwC. So I worked there for a little bit, and then I wanted to get experience working at an in-house tax department. So I used to practice in the services side in the accounting firm industry, and then for a couple of years, like in 2017, is when I decided to shift my career and work at an in-house tax department. So I was working on the other side in the client in-house. And so it was a great experience. And then one of my buddies was always telling me, hey, you got to open up your CPA practice. I have so many clients I could refer you, this and that. And I was a little hesitant at first because I was like comfortable on W-2, but I know I've always wanted to start my own practice. So pretty much I kind of bit the bullet. And I had two jobs from 2018 because there was no, and the reason why I took advantage in having this to start my CPA practice is because there was no conflict of interest with my prior employer when I was working at an in-house tax department. It's not like I'm taking any of their clients away or anything. So pretty much I worked two jobs from 2018 until 2022. And then 2022, I grew my clients to the point that I felt comfortable that I was able to quit my job. And my wife has also helped me in this journey as well. She works with me. She's my partner and so forth. And basically, once I felt comfortable that we were able to generate enough clients to replace my W-2 income, I took the leap of faith, and it's the greatest decision of my life ever since then. So June 2022 until now, I've been fully self-employed, running my CPA practice 100%.
It's usually how it goes, I believe. Well, that's how mine went, and I'm almost positive that's also how John's went.
Yeah, exactly. That's pretty much what happened with me. I worked full time and plus business until it didn't make any sense anymore.
All right, so then let's jump straight into it. I know we've had some conversations offline and a couple conversations you and me had earlier in the year where we were talking about things, and you were telling me about the BOI. So for those that don't know, why don't you give us, just give us the overview and let's talk about that for a minute.
Right. Okay. Yeah. So basically, for me to explain what the BOI report is, I kind of have to take 2 steps back to explain the current situation, and it makes more sense. So over the years, it started mostly back in 2021. Okay. Congress has pretty much, they've been really fed up with the fact that a lot of people set up LLCs and they'll do it for illegal purposes. They'll set up an LLC. Like they're trying, in other words, Congress is trying to target financial crimes, but that's not tax related. So they're trying to target companies, people that are drug dealers, money laundering, all of that stuff. Okay. They're trying to track those type of people. So they've been fed up of the fact that a lot of people have set up LLCs. They'll make up a random fake business and they'll have it under their name. But in reality, it's being operated by other people that are doing illegal acts. And in other words, they're trying to capture those type of people. So this is not tax related, but this is something that they've brought up a lot of this attention to CPAs and attorneys to advise their clients about this new reporting requirement. So, and it's not even with the IRS they have to file with. So Congress created an act called the Corporate Transparency Act. They set that up in 2021, and basically they just want to create the transparency and everyone being kind of like saying the truth of what companies they own and so forth. So that's kind of like the brief history. And then they put it to be effective starting in 2024 tax year, which is this year. And now that was the rewind. And to right now, the report is the BOI report. It's an acronym. It's truly called the Beneficial Ownership Information Report. And basically what it is this is targeting small business owners. It's not even targeting big companies like Tesla. It's not targeting that because they're just simply trying to target who owns what LLC and stuff like that. And so the reporting of this has to be submitted to the acronym is FinCEN, but it's really, and think of them as like the brother sister company of the IRS. It's the Financial Crimes Enforcement Network. So they're like the brother sister company of the IRS. And basically all you have to do is just log in, report that, hey, for example, me, myself, I, David Rodriguez, own Rodriguez Advisors LLC. And that's pretty much it. There's no tax that needs to be paid. There's nothing, pretty much. There's just a few miscellaneous questions, but it's just, they just want to know what I own. So in that example that I just gave, that's pretty much the reporting requirement. Now, the thing is that the dates of when they're due, it is kind of strange and awkward in a way, but it is something important to take into account. The due date. So if you had already set up your LLC before 2024, that if you already had it set up by December 31st of 2023, then the due date to submit the Beneficial Ownership Information Report, the BOI report, is on January 1st of 2025. I know it sounds weird, but those are the rules. And I think they're doing that because they know that there's so many people in this country that are clueless about this. and I think they want to give enough time for all professionals to advise everyone that would have a filing requirement to actually report it. That's why I think, but I'm not in Congress's brain. Then this is the other deadline that is extremely important. If you set up an LLC right now in 2024, so May 16th of 2024, okay, you will have 90 days to complete and report the FinCEN. So you don't wait until January 1st of 2025. You actually have to file. So like if let's say today, May 16, about August 16 would, like if let's say we file and you set up an LLC today, by August 16, 90 days, generally speaking. I know some months have had 30, 31 days, but generally speaking, 90 days from today. So let's make believe each month is 30 days. So from today, if you have an LLC set up and it's formed and everything, 2-day effective, the BOI report needs to be filed with the FinCEN by August 16th, which is 30 days from now. I'm sorry, 90 days from now.
I feel like there should be like almost like a little bulletin board on like, these are the 5 things you need to do when you open up a business. Like some things you know, some things you can find out. And I know that once you register your business, like when I first registered my business here at Sunbiz, John. So when I first registered my business on sunbiz.org, I got a letter in the mail that said, hey, would you like help doing this, and this? And they file everything for you for a fee. But otherwise, you don't know what else you need to go file, you don't need to file.
Well, one of the things is you always want to be careful. There's that actually brought up another topic of discussion too with that, because, and especially since you're in IT, I know you're very familiar with these type of things. The fraud especially in the state of Florida, I'm sure it's all over the US, but here in the state of Florida, it's out of control. Every client that I set up an LLC for, within that same week, they're getting letters from people making up fake requirements, specifically saying, oh, you have a filing requirement to file your corporate minutes. You're going to want to pay it to this email, this address, all this stuff. And I tell my clients, anything you get in the mail, send me a screenshot or send it to me. Email it to me, send me a screenshot, whatever it takes. But don't pay anything until I see if it's legit, because there's so much fraud.
Yeah.
So that's one thing. And another thing is that the state, I mean, in the state of Florida is trying to do this. Unfortunately, not everybody reads their emails, but whenever they give clients like taxpayers, business owners, reminders of the annual report that's due, they actually added the paragraph right under when they say, oh yeah, your annual report is due on May 1st of 2024. They actually added a paragraph. Unfortunately, nobody ever reads it, but they actually added a paragraph right under that explaining the BOI, which is kind of crazy because I'm actually surprised they actually did that.
You're right. I know they don't actually read it. So it's actually a good segue into our next topic, which is, when people start up, what are the common mistakes that they make? I know, I made 2. One was I wanted to be an LLC, but taxed as an S corp, and I filed as an LLC. And then on a questionnaire, I put that I wanted to be taxed as an S corp, but it wasn't the same as when my CPA, in this case, it's happened to have been you, told me that I actually need to send to the IRS and let them know. So I know other people make those type of mistakes. I also made the mistakes of thinking that that if I wasn't selling anything, that I didn't need to file anything for the quarterly sales tax. And you need to file at least the minimum. I think it's $50 or something like that. So just little things here and there that, it's not really in the rule book per se. And you just kind of got to either know or be taught or have somebody with the expertise to guide you.
Right. Yeah. And so when you set up an LLC, right? So an LLC is not, think of an LLC as like the baseline type of entity, right? It's not a tax saving. People have a misconception thinking, oh yeah, I set up an LLC as a tax saving. No, not really. It's very flexible. That's the beauty of it. So think of it as like the baseline, right? Okay, let's put it right here. It's the baseline, and within this baseline, you have, with the proper planning, you can structure it in multiple different ways. You can legally be an LLC, but elect to be taxed as an S corp. You can even elect to be taxed as a regular corp. And if there's a multi-member LLC, you can elect to be taxed as a partnership, or you can still be an S corp, because an S corp, you can have multiple shareholders. Because that's the thing, is that when you're an S corp, you're technically considered a shareholder, versus when you're a partnership, you're a partner. So by default, a partnership has to have two members at bare minimum, no matter what.
Yep, I think that's
It,
the
it,
definition.
it can't have one, because then it's not a partnership.
Yeah.
Now, S corps is even a next level of flexibility, because it can have a single owner, one shareholder, or it can have multiple shareholders. But there's also additional rules around S corps and everything like that. But one of the things is that when you set up an LLC, okay, and you want to be taxed as an S corp, there's certain, and in addition to that, if let's say you want to change your classification of an LLC, of a multi-member LLC, right, and you're still legally an LLC, but you want to be taxed as a partnership, let's say, right? Well, there's certain forms that need to be filed. So, for example, if let's say you want to become an S corporation, you have to file this form, which is Form 2553. So, even if you answer the questions when you fill out, when you apply for your federal FEIN, your tax ID, and you fill it out and you're intending to be an S corp from day one, it technically even though you think that you're answering the questions right, which you probably are, to be set up as an S corp, unfortunately, you won't be an S corp from day one. You have to file this form called Form 2553, and unfortunately, the IRS has not upgraded. I mean, yeah, they are upgrading the technology and a lot of things, but in a lot of other things, they're still in the Stone Age. And Form 2553 has to be paper filed. It has to be mailed to the IRS. It can't be electronically filed. It can be faxed, but I haven't had good experiences with faxes, because I've sent faxes over and I've gotten confirmation that's never received and so forth. And I just prefer, me personally, if I'm gonna mail something, I prefer mailing something to the IRS than paper filing. I'm sorry, mailing instead of faxing.
Got it. John,
Who
so how
has a-
about
Who has a
how's your-
fax machine? Like I had a fax number on my phone system. I had that fax number for a year and a half, and I don't think I used it once. And so I reutilized it for other things.
I have the fax number too, the e-fax, and I don't think I've ever received or sent one. I just thought, I'm opening my business. I guess I need one, so I got it. But I don't think I've ever used it.
The only time I ever used the fax is literally with the IRS, because everything is by email. And the funny thing is that it's really mostly the IRS, because the states, like state government authorities, they're not as strict. Like they'll accept, they'll acknowledge by emails. So it's just it's an IRS thing.
So it's funny that you said I got confirmation that they didn't get them. So I always got confirmation.
Yeah, because I wouldn't
get confirmation that they got them. I always got confirmation that they didn't get them.
Well, yeah, I actually had confirmation that they didn't get them, because in one of my clients that I faxed it over, so when we do an S corp, like what I typically do is when we send out the S corporation election, I always save a certified mail receipt, or I save something that shows that it was sent, whether it was by fax or a certified mail receipt. That's hands down. Now, the thing is, one time with my client, he got a letter saying that they weren't, they never received the letter of the S corporation election. So I was like, no, that's not true. I actually mailed it, or I actually faxed it. And so there's times that like I still get confirmation. As a matter of fact, like I got one of my clients that actually sent me a letter today. I'm sorry, yesterday. That yeah, I got this letter, and I'm like, I'll take care of it. This happens all the time. Sometimes it happens through a cross of the mail. So like if let's say I mailed them the S corporation election, let's say in March 1st, but then they hadn't received it yet, and then they'll send a letter on March 10. And the thing is that they take forever to process everything. So you can mail something and just they can send a letter saying that they never received it, but they actually did. It's just they haven't reviewed it yet because it's on a huge pile of a bunch of other stuff that they've gotten.
Got it. Man, that's crazy. I had the question like right here, and now it's going. Oh, so I'm sure there's mistakes. You know, you have a handful of clients. Oh, I'm sure you have more than a handful of clients. Sorry about that. What do you see as like, man, every time I take on this client, like I always see this error, I always see this mistake. Like no one does these 2 or 3 things right ever. Like what are the common mistakes that you see that people should definitely avoid because it can hurt them, not only when they're filing taxes, but maybe within their own business and the numbers and their own accounting?
One of the biggest mistakes that I see is the way that people try to deduct their vehicle. People have a misconception, like the average person. And the thing is this, is that really, accounting, taxes, it's an acquired taste. Not a lot of, it gives a lot of people anxiety and it grosses them out. And it's also complicated too, so it's really an acquired taste. So what happens is that a lot of people have a misconception that, let's say, for example, like if let's say you go to, I don't know, like a discount auto part and buy some type of supply to fix your vehicle or something like that, or like an oil change, right? Well, that's a day-to-day regular expense that you could just deduct right then and there. But when you buy a vehicle, it is technically an asset. And a lot of people have a decent level of understanding what a P&L is, which is your revenue and expenses, right? You know how much you made, how much you spent, what's left over at the end is your profit. But a lot of people, what I like to joke around and say that this separates the men from the boys, or this separates CPAs from regular tax preparers, is a much deeper level of an understanding of the balance sheet. The balance sheet is an entirely different animal. It really, that's what truly calculates the net worth of your company, which the net worth is equivalent to equity. So basically the main formula for your balance sheet is assets equals your liabilities and equity, no matter what. So if you have $10 of assets, but you have $20 of a liability, then you have a negative equity. So no matter what, it's just going to match. No matter what. So what happens is that a lot of people have a misconception. Okay, I buy a car. Beautiful. I'm going to write that bad boy off. I bought it for $50K and I bought it in cash. Perfect. Any regular person would think that. And I don't blame them. Now, the thing is, but the thing is, it's not an asset. And it doesn't get expensed right then and there. Now, what happens is that technically when you buy a vehicle, okay, and you use it for more than 50%, you can use that vehicle and start deducting it in your tax return. And so when you buy a vehicle initially, no matter what, even if you buy it all in cash, it has to be reflected as an asset. And what an asset truly is an investment that you're doing into your company to generate future cash flows and increase your revenue in the long run. So if let's say you have to buy some type of machinery or equipment to create the products that you want to eventually sell. So your vehicle is something that, and another thing too is that an asset is something that is also going to last for multiple years. So it's an investment that you're doing to your business to increase your cash flows, but that investment, like the benefit that you're going to get out of that asset, that investment that you're putting in, it's going to last for multiple years. So a vehicle, generally speaking, has a useful life of 5 to 7 years, but mostly 5. There's some exceptions for 7, depending on the type of vehicle and so forth. But generally speaking, 5 years, right? So let's say you buy a car for $50K and you buy it all in cash. Generally speaking, that does not go to your P&L as a car expense. $50K. No, it doesn't work like that. You buy a car for $50K, and let's say you're financing it. Let's say there's, you didn't buy it in cash, right? Let's say you're financing it, because this is a little more realistic. You buy a car for $50K and you're financing it. What happens is that in accounting, there's always a debit and a credit. And that initial transaction is going to go into your balance sheet. So you'll have a $50K asset and a $50K liability because you're financing the whole thing. Now, you might be wondering, okay, well, how am I going to be writing it off if it's not going into the P&L? It's possibly one of my favorite deductions. It's depreciation. So what happens is that when you buy an asset, such as a vehicle, you depreciate the asset over the useful life. So if you buy it for $50K, generally speaking, it's a 5-year life. You get $50K divided by 5 is $10K. And you depreciate, and that's how you recuperate the cost of your vehicle through depreciation. The depreciation goes in your balance sheet as a deduction. Now, there's 2 different bodies of laws. There's accounting rules and there's tax rules. Accounting rules is what I just explained. Tax rules, basically, you could still abide by the accounting rules, but since it's a different regulatory body, they also add additional incentives to incentivize the economy. So if they want people to purchase more cars, let's say, because the car industry is slowing down, they'll say, okay, you know what, we're going to allow you guys to claim 100% bonus depreciation, which happened back when Trump was president. They elected that you can take 100% bonus depreciation, and that lasted for multiple years. Then starting in I can't recall if it was 2022 or 2023. I think 2023 was the first year that now bonus depreciation can be a max of 80%. Then 2024, 60%. And it's slowly getting phased out. But that basically, if let's say, hypothetically speaking, we go back into the time when Trump was president, you buy a car for $50K, you can elect to depreciate and write off the entire vehicle that first year through depreciation. So you'll be able to write off the entire amount. But I'm not always a big fan of that. And the reason why is because, let's say, right, year 1, you're in a situation that you're cash flow sensitive, but you want to write off the vehicle entirely. Well, fine. You're going to write it off. Okay. But let's say year 2, you're more profitable and you didn't buy another vehicle. Well, from a tax perspective, you're no longer going to get a benefit from that vehicle from a write-off perspective, from a depreciation standpoint, because you already wrote it off in year 1. So I always try to kind of like use that as like a last resort if the tax liability is out of control for my client, but I try to not use it. And I try to, because I've seen it already in practice. I've been doing it already for a couple of years, that one of my clients, right, we took bonus depreciation for everything. And then I explained to him, I'm like, the reason why your taxable income is not as low as it would have been last year is because you're no longer getting a benefit because we wrote it off entirely last year. So it's always important to kind of like, weigh out like the pros and cons and see like how you're projecting to do at the current moment and in the future to see if it's worth taking bonus depreciation or not.
Okay, I have lots of questions. Are you ready?
Yeah, go for it.
Okay, let's talk about the benefit of buying a vehicle under the company versus buying a vehicle under your name and then writing it off. Let's also talk about the benefit of doing a lease in the business and just having an expense.
Okay, so pretty much A lot of people have a misconception that you need to purchase the vehicle under the business name to be able to deduct it. And that is not true. You do not have to, like, if you use your personal vehicle
I wish I would have known.
for more than 50% for business purposes, then you can deduct the business portion of the vehicle expenses in your tax return. So, and basically that's kind of like the way it works. So you don't, I mean, to my knowledge, the main benefit you can truly get in having the vehicle under your car is the fact, I'm sorry, having the vehicle under the business name as a business being the owner is, if you're ever audited, I feel like it's harder for the IRS to argue and state, hey, you know, that vehicle, you didn't use it for business purposes, and you could easily be like, well, I literally have it under the business name. But apart from that, really, there's no specific requirements, and there's really, you know, no additional pros and cons that I could think of from the two. It really makes no difference. Now, what was your other question about with the with the lease? So when you have a lease, think of it as rent, right? You know, think of it as if let's say for the average American that is not that doesn't own a home, that they're leasing, that they're paying rent expense. So when you are leasing a vehicle, the rules change a little bit. Because you don't have an asset on the books because you don't own it, the monthly car payments are deductible as quote unquote lease car payments, similar to how rent would be. Like if you're paying rent for, for office space and how that's deductible, it's the same way, just in a different line, not in rent expense, but more in the car and truck line.
Yeah, which makes, to me, I've considered, so we have a truck under our business for a lot of different reasons, because it keeps our personal credit and our business credit separate. But I've considered in the future, not now, but in the future, just leasing vehicles, just write it off as an expense, and then you just swap out your vehicles every few years, and you just know, like you're somewhat like this, you're throwing away money like you do rent. But you also don't have to pay, like you're not paying depreciation on those. You're not, it's a fully covered vehicle for your business. And then, every 3 years, you just get a different one.
Right. And so, like I said, there's no problem with that. And, if anyone were to ask me what's better, leasing or buying, I would say it depends. Just like, and that's the famous answer that what CPAs would give or what attorneys would give. It depends. Because, for example, right, the good thing about a lease is, let's say you're paying, I don't know, $500 a month, let's say. Well, it's a guaranteed $6,000, assuming you use it 100% for business purposes, $6,000 deduction. A guaranteed every year, $6,000. Now, when you're financing and you own your vehicle, okay, there's a little more flexibility because you can take a bigger deduction up front. Like if you want to take, because there's different types of deductions. There's bonus appreciation, like I mentioned, but there's also Section 179. There's different types of there's different type of ways to take a bigger portion. So you could take a bigger portion, like let's say if the car is $50,000, you could take up to, depending on the size of the vehicle, if it's under 6,000 pounds, your bonus appreciation is capped at, like, I believe $18,000. Versus if you are buying a vehicle that weighs more than 6,000 pounds, you could literally write off up to the most, like before you could write off 100%, and now it's up to 80%. Well, actually, it was 80% in 2023. In 2024, if I recall, it should be back down at 60, but I think they might have put it back into 100. I'll have to double check on that. but I know but I know 2023 was the first year that was phasing out. But yeah, so what I'm trying to say is that there's more flexibility when you're financing, when you own your vehicle, because you could take a bigger portion the first couple of years, but then the later years, you see, you'll probably be deducting less than if you were leasing. Right. So it really, there's more flexibility, more that could be planned out. But like I said, it really depends on your current situation. Leases are still good regardless. It's an automatic deduction, but there's more flexibility and more room for creativity when you own the vehicle.
Sure.
Wish I would have known some of that stuff a year and 2 months ago.
Oh.
All really good though. All really good. And I had a lot of these questions, and in our circle, David, like in our IT circle, we have a couple of Facebook groups, and these are the type of questions that go around. Hey, how are you guys doing this? How are you guys doing that? Are you doing this for the business? Are you doing this on the personal side? So it's really good to have some of that information for some of our listeners. So thank you, and we appreciate it.
And taxes are confusing, right? Yeah. And it changes every state that you're in. There's Washington state taxes for digital stuff, and it's extremely confusing as to whether what's taxable, what's not. If you touch it, it's taxable. If you don't touch it, it's not taxable. Just weird stuff like that. What?
Yeah. Oh, yeah. Like you're talking about like sales tax and stuff.
Sales tax. Yeah, it's like
sales tax is very
digital thing.
Yeah, sales tax is it's a very tricky one, because historically in the past, and it's evolved more complicated. It's become more complicated because the market has become more complicated. Because back in the day when I was an undergrad and my master's back then, which was over 10 years ago, it's basically the rule of thumb is if you're providing a service, then you're not subject to sales tax. But of course, this is state by state. So every state is different. But generally speaking, right, if you're providing a service, so like me, right, I don't sell a product, I provide a service. And based on that service, I'm not subject to sales tax. But then but then if you're selling a product, so like if you're going to go to Publix, or if you're going to go to any grocery store and buy food, I mean, it's a product that you're buying. It's something that's tangible. Right? So what you could touch, that word is tangible, right? So, if you're buying something that's tangible that you could touch, that's a product, it's subject to sales tax. The thing is, it's now with Amazon and with everything that is dealing with e-commerce, that you can sell stuff online and everything like that, it's created additional complexities within that, because and especially when you're buying from one state to another, and every state has different laws around that. Yeah, I mean, that's
a huge issue for me, ordering computers for like my clients in different states. And then some of my vendors will be like, oh, you're not authorized to sell in that state, so I have to tax you like up front. Usually I'll get it from like my resellers. I don't have to pay tax because I have a reseller certificate. But if it's in a different state, then it becomes a whole issue. And I'm like, you know what?
Yeah.
Just let's ship it
to
Florida.
And then there's like, do you tax
Florida, and I'll handle how to get it to that state later.
Certain tools get taxed. Like, this is in our industry. Certain tools get taxed. Like Google Workspace wants to tax you. And then if you're creating that as a service all in one package, is it taxable?
Like, yeah, so that's a tricky part. Yeah, because for example, and like if let's say, a portion, like if let's say you're sending an invoice, and like let's say you're sending an invoice for $1,000, 500 of and out of that $1,000, 500 of it is related to a product, versus the other 500 is part of a service. Then, like, generally speaking, on your state sales tax return, you would put like $1,000 of a sale, but then 500 as exempt for the service portion, and then the difference would be reflected as like taxable sales.
Yeah, I find a lot of people who just tax the whole thing, which sucks, because you end up having a higher tax bill. Your client ends up having a higher tax bill, because the law is so convoluted that this was happening when I was working in the alarm industry. No one wants to get an audit and they were going back on businesses 5 years and saying you owe us 5 years worth of recurring business tax.
Ooh.
Yeah,
Yeah,
this is
I'll
like
send
a
two
thing that
bills
was
in that
happening in
case.
Washington State. Like,
I don't want to put myself in that predicament or my clients, so I would just send two bills. Here's one for hardware. Here's one for services.
yeah,
That's
so it's confusing. It's confusing in those areas, like especially Washington. But okay,
Yeah,
so what's the? Oh, go ahead. Okay, I'll go. So what's the worst? I just want to know. Tell me a story. I always hear the accountants who talk about, oh, well, you know, I always have that guy who brings in like a box full of receipts, you know, carries it in and says, okay, here you go. What's the worst CPA thing or maybe just worst business thing that you've seen? You know, that you've seen happen or that has been maybe a big pitfall that people can watch out for that would put them out of business?
it's really important that, like, I guess like some of the things that I've seen that's messed up is when I've gotten my clients' books that they were using, uh, like not an accounting firm, but I guess like you know, a tax preparation team to do their accounting work, and that it's been insane. It's been insane because because the thing is just because you're a tax preparer, that doesn't mean that you know how to do accounting. You could literally just plug in information in the tax software, but that doesn't mean that you know how to do the necessary work in financial statements, in a P&L and a balance sheet. So I've seen things on a P&L and a balance sheet and journal entries that just make absolutely no sense when it's done from when they've used a different, you know, like when they use these tax preparers to do their accounting. That's I mean, they've overpaid in tax. They've in, they had their income double counted. They don't even they some of the things, like, you know, they were subject to, they were always late on filing the sales tax per se. All those years, you know, like like that time frame. You know, and the thing is, a lot of people don't think about the fact that if you don't stay on top of your finances, you can definitely go out of business because you could think that you can afford more things. In reality, you can't. And a lot of people have a misconception and they think about how much money they have in the bank will depend on what's truly profitable for them. And that is so not the case, because, and I can give you a little example on cash flow issues that would cause that. Never forget, one of my clients that was here, I told him, yeah, you know, you have an $89,000 profit in the books. And he's like, but that's impossible. My bank account is nowhere near that. That just doesn't make sense. No way. And then I had to explain, well, if you're taking out distributions, okay, you're going to vacations that are not tax deductible and they're not part of the business, but you're still using your business account for all of these personal transactions that have nothing to do with your business, that's not tax deductible. Mm-hmm. It's going to be a double whammy, because one, your cash flow will decrease because you're spending money. In addition to that, you're also reducing the equity of your business, because remember, like I said, your balance sheet is your assets minus your liabilities plus equity. So if you take an owner's draw, you take a distribution out of your business, it's not illegal or anything. I'm not saying that. But for your business per se, it's the outcome, it's kind of like a negative effect, because you're not getting a write-off for that. And there's no P&L impact, because all you're doing is reducing your cash. So you're reducing your asset, but you're also reducing your equity, because you're reducing cash, which is an asset, and the other side of the entry, you're reducing your equity. And in other words, that's a typical example of how your bank account should never be reflected as to how profitable you truly are. And that's a big mistake that a lot of people tend to have, tend to take into account. And a lot of people have a misconception that they think that they have and I always have to explain this very thoroughly, multiple times at times. They have a misconception of what is considered a distribution and what is considered an actual salary. Because even though, let's say if you're taking out money, right? Let's say you withdraw, let's say you're not organized, you're not paying yourself a salary. Let's say you withdraw $5,000 out of your business account. You transfer from your business account to your personal account to pay for your mortgage, electricity, all that good stuff. Like all of your household expenses, your personal expenses. Well, what happens is when you do that transfer, okay, it actually is equivalent to withdrawing money out of the business as a draw, because it's not a deductible expense. Like my mortgage, as much as I would love to deduct my mortgage, it's technically not a tax deductible expense. And now, there are a couple of exceptions to that, the home office deduction, stuff like that. But generally speaking, it's not deductible. So, those are kind of some of the, the struggles and things I've seen about about the way how people have managed their money and their limited understanding on how they manage their money and how it affects the financial statements and so forth.
I have a quick question. We don't have to go too deep into it, but give me like a quick 2-minute overview. Receipts. Do we need every receipt? Do you need only receipts for certain things? Receipts.
Generally speaking, I mean, if you have QuickBooks, like if let's say, for example, you have QuickBooks, I see the bank statements. I don't need to keep receipts. I mean, the bank account will have a description of what you buy. I mean, granted, now let's say you go to Discount Auto Part and you buy a tool. I'm not going to know the specific tool you got, but it shows that you got a tool. Now, I think it's important to kind of like get receipts for big items, right? Like if let's say you purchase a vehicle. Yeah, I would love to get like the purchase agreement, because that's going to show how much of a down payment, the interest rate on the financing part, and all that. And it's going to show the total purchase price and everything. So that definitely. But like, keeping receipts, I guess what I would recommend in keeping receipts would be more like if you paying for business expenses out of a personal account. I don't recommend doing that ever. But unfortunately, I have clients that don't listen to me, and they still do that even after I've told them they shouldn't.
I've only kept the gas ones and then the meal and entertainment stuff. Just for some reason in my head, I thought I had to. I mean, not physically. Like I'll take a picture, I'll upload it to my QuickBooks app, and then QuickBooks maps it to the expense. Hey, I found this information. Does it apply to this transaction? But I just always got contradicting information from different sources on when you should keep receipts, when you shouldn't. But that makes sense if you're paying out of your personal. But otherwise, there's an electronic, transaction somewhere that you can map to it. And of course,
exactly. Like because that's the beauty of doing everything electronically if you're swiping. Now, what I don't recommend, which unfortunately I have too many clients that do this, that it kind of gets a little frustrating, is there's still a lot of people that haven't moved up with the times, and they try to they have a business account, but they barely even use it because they still manage everything in cash. So they'll have people that will pay them in cash, right? But then, so I have a client that he gets paid in cash, but then he uses that same cash to buy equipment. None of that ever gets hit. None of that hits the books.
Got it.
None of that. And that's one thing that I really do not recommend to stay away from. Because yes, fine. People try to do that to, let's say, oh, I don't want to pay tax. So you know what? Let's do everything in cash. Okay. If you want to do that, fine. Go right ahead. But then when it comes time, if you want to purchase a home, you want to purchase an investment property, you want to get a line of credit, you want to get some type of financing, you want to enter, you want to sell the company for any reason whatsoever, It's not going to happen because there's no record of anything that would be enough to make those type of deals, pretty much.
Yeah.
All right. All right. So let's jump to our last segment real quick. Just do you have any tips or tricks or advice for anyone that, is trying to do everything on their own per se?
One thing that I do recommend, okay, it's a very tough struggle for startups. This is what I always tell all of my clients that are startups, that I always recommend they can have a consultation, maybe once or twice with a CPA, and learn how to kind of like navigate QuickBooks. Maybe they can take a QuickBooks training course. But basically, I'd recommend for startups to try to do their own accounting. Why? Because startups, you're cash flow sensitive, you're starting up. It's going to be hard to afford a lot of other things, and you're trying to market yourself, but at the same time of marketing yourself, you also have to be you're kind of like a one-man show doing a bunch of departments. You're your own marketing team by marketing yourself, you're your own accounting team because you have to keep track of your finances, you're your own field employee for if they need whatever they need, you're actually going to provide that service for whatever you're doing. I always recommend to try your best to kind of like stay on top of your finances too, and I know that's difficult, but at least every other day or once or twice a week to take a few hours, an hour or two or whatever it takes, but to stay on top of your finances, because it's something that it's very important. Because if you can make a lot of money, but if you don't know how much expenses you have, or if you're not keeping track of that, you might think you're making more money than what you're truly making. You might be overspending how much you really have of free cash flow after all your expenses if you're not keeping track of them. So I think to try to do it.
The best thing I did when I started my business was I got QuickBooks right off the bat.
Yeah.
And I kept my business finances completely separate from my residential or my consumer stuff. So and I was working a job at the time, so it was really easy. I was making enough money that I didn't have to worry about paying for my expenses, and it gave me money to save to quit my job. But I knew what my business was making, and it helped me make informed decisions about what next steps were moving forward.
Yeah, I was always separate on mine. It was always separate.
Now, the one thing I always tell my clients too is once you get to a point that you have grown your business, that you are so busy because you're growing so much that you literally do not have time to do any accounting work on your end or keeping track of any of your finances, then that's when I recommend to get with a CPA to help you keep track of your finances. Because I tell that all the time with my clients, all the time. And it's because the thing is there's people that will try to hustle startups and say, no, you know what, you should get a CPA, you should get an accountant from day one. Technically, yeah, it's always important to have an accountant no matter what. But I'm being realistic that, I always try to put myself in the shoes of my clients. And when you're starting off, you're cash flow sensitive. So I always recommend my clients to keep track of your finances. But once you get to a point that you don't have time to, and you can actually afford a CPA on a monthly basis, then let's talk. And my clients have respected me from that. They like when I give that advice because they know that I'm not trying to be money hungry and trying to, have them charge, me charge them when I know they can't afford me, because it's the human side of being a business owner. It's kind of like being real, being transparent, hey, just deal with it, keep track of it as long as possible until it gets to a point that that you don't have time to keep track of your own finances. Then you can talk to a CPA on a monthly basis.
That's one of my funnest parts. And somebody always told me, if you don't know your numbers, you don't know your business.
That is true. I can't agree with that anymore, man.
If you don't know your numbers, you don't know your business. Yeah. Well, anything to add, John?
No, this has been good information. Appreciate you being here.
All right. Well, thank you very much, David.
Thank you guys for having me here, by the way. Thank you.
No problem, man. Go ahead and plug your CPA firm. Tell anybody any information you want them to know, your socials, your website, how they can reach you if they have any more information or questions.
Okay. Wait a minute. I'm sorry. Can you repeat that?
I said just let everybody know the name of your business, how they can reach you. I have some of your stuff.
Sure. Yeah. So the name of my business is Rodriguez Advisors LLC. I'm based out of Miami. It's me and my wife. We run the CPA practice, and our phone number is 305-396-6600. My email is on the link of david@rodriguez-advisors.com. And
you guys do anything else around besides CPA that you want the people to know?
I'm sorry?
You guys do anything else besides CPA that you want people to know, like the other services you provide?
Well, yeah, I mean, like the services we provide is we do monthly accounting, sales tax returns for our clients, monthly accounting. Sometimes when my clients need to, so like for example, like I charge my clients in a way that like as a retainer fee, as like a monthly subscription. So pretty much if my client, like for example, like I got a call this morning that one of my clients needs me because they're going to be selling one of their companies. And so they need to have their financials up to date because the potential buyer is going to be here next week. So those are the type of things that I get calls from my clients. And those are the type of services that we provide, basically helping all of our clients staying organized financially. So that way, when there's an event, even entirely separate from your tax return, for example, you're trying to get a loan, you're trying to get, third-party financing, you're trying to sell a company. There's so many different things. We're readily available.
Yeah.
All right. Well, thank you very much. All right. Thank you very much for having us. I'm sorry. Thank you very much for joining us, David.
No, thank you guys for allowing me to be here, man. I really appreciate it, man.
No problem. Thank you. And why don't you sign us off, John?
Yeah, well, we're going to move on to our next cybersecurity segment in just a second. And so, Dave, thanks for bringing us your information. And we're super glad you came. And so we'll talk to you soon.
Perfect. Thank you.
Okay, Amelia, we're going to talk a little bit about what does it take to become a hacker and make money.
So pretty much how easy it is to find malicious tools online, right? On the dark web, just anywhere.
It's crazy. Like when you look, we've long said that you don't have to have a degree. You don't have to have much cybersecurity talent or programming. You just have to have $309
or malicious intent.
For malicious intent. So $309
can get you what we found here.
Yeah. $309 can get you a unencryptable updated, a bonus 20% off discount for the Philadelphia ransomware. It's insane to me. Like we live in this day and age. Here's another one. This is another article by Trend Micro that says the Stampedo ransomware sold cheap on the dark web, and it's $39. $39 to mess people over and steal a ton of money and destroy businesses. It's just.
I guess what we want our listeners to take from this is how easy it is for anyone really to just find this information either on the regular web, which John just found, or on the dark web, which it makes you jump through some hoops, but it's very, very accessible. So the examples of some of what we're finding is you can pay a one-time fee and you're downloaded this package, let's call it. And with this package, depending on how you deploy it and how you want to monetize it, that's up to you. But it's giving you all the tools you need to hold somebody's files at ransom, right? That's one example. We found another example that it was an Outlook exploit, right? So you pay them a certain amount of money, and for that amount of money, they give you an exploit. Then you have to figure out how to deploy it. But I think one of the ones that I was just briefly talking to John about that really caught my attention was, it was like a wanted ad. It said, looking for someone in a company that works in a company that the company has to be worth 10 million or more, and they're willing to pay the person $50,000 if they're able to walk into their office and plug a USB into any computer. And if they're able to access anything with that USB, then they will pay that person $50,000. So imagine an office with no cameras, no USB blocking capabilities, and someone just walks in and plugs something into a random computer. It doesn't even have to be their computer so that they don't get caught, but to any random computer, and now someone has access to your network. What's your take on that, John?
Well, I think what's fascinating. We wonder why cybersecurity attacks have risen dramatically. I mean, COVID kind of pushed everybody into their house back in the 2020s. But when you really think about it, it's accessible now. Any lowlife who doesn't want to work a regular job or doesn't want to go be an entrepreneur and work hard can go and purchase a package and begin to run a malicious, illegal business to try to scam money off of people. And like when we started businesses, the entry level, cost to get in was definitely more than $300.
I found one for $40.
Yeah, or $40, right? The cost to entry to be a cybersecurity criminal is super low. The barrier is super low.
And the ceiling is super high, right?
And the ceiling is super high.
I think one of the stats you've been reiterating is that it's a lot bigger than the drug trade now, correct?
100% it is. And I was doing a presentation today for a networking group, a chamber networking group. And one of the things we talked about was somebody asked me, well, how do you prevent all of this with AI becoming prevalent? And the answer that I gave them was, you solve it the same way you solve every other cybersecurity problem. You train your employees continuously to do the right thing and to keep an eye out. So even these $40 ransomwares, they're nothing new. They're just packages. They're just, they're cheap, but they still have to be sent out, and they still have to be open, and they still have to go through a person who has to do the wrong thing in order for that to happen. So the biggest tool that we can be using is to train employees and actually put effort into it. Can't tell you how many times I walk into office and say, do you have any cybersecurity training? We're like, well, we've talked about it, or no, or why do we need that?
Or last quarter we sat down and saw a 5-minute video about something, and then
right. And rather than putting real effort into it, and here's the thing, it's really not that hard. It's as easy as having a product that you can sign all your employees up for. I give my yearly training out for free. You get them signed up, and if it's a really good product, it's going to have what we call gamification in it, which means that your employees get points the more times they go through quizzes and they do the micro trainings and all of that. And at the end of the 6-month period, you give them a gift card if they kick butt and got over a high score. Like,
I like exactly how you put it. You said, they can't get in unless you let them in. So definitely have 100%. To guard the front door with user training.
Well, right, because we know that 98% of these cyber attacks come through email. And we also know out of that, 98% of them have to go through a human to make that mistake.
Yeah.
So if you train the human to make really good decisions, you're going to eliminate or at least significantly lower the chance that you have an incident in your business simply by talking about it, simply by having conversations. Like, how is that not worth it?
Oh, definitely. I was having lunch yesterday with two attorneys, and one just happens to be my client, the other one doesn't. And we were talking, and one of them was like, "Oh, one of my paralegals just fixes the computers here and there." So my client asked him, "So what would you do if you're hacked?" And he kind of froze for a second. And I'm like, "No, really, really think about it. Like, what's the first thing you would do? You have to call this person, that person, and that person." And I'm like, that's also part of the training, right? So it's not only what to look out for. Oh, because he made a comment and said, "Look, you can put all the tools, but you can't tell me I'm 100% safe." And I said, "You are absolutely correct. You are never 100% safe." That's why we do 3 layers, right? We train your users, we put tools in place, and then just for when those 2 fail, we create a plan to not only mitigate whatever happens, but to have business continuity and disaster recovery right after.
Right. Because we're not necessarily talking about, I mean, if you train employees, we're talking about, there's multi levels of training. We're training people to watch out for things, but then there's also a training of what do we do if something does get through? What if something happens? Good example from Washington State, Whitworth College had a major cybersecurity attack. I think it was 2 years ago that they had an attack, and they ended up still having data stolen, going through the whole process. But at the end of the day, the owner of or the CIO of the organization had everything in place. Every department was trained. They all knew what the action plan was, all of that. And he significantly reduced the blast radius that it could have been by being prepared. So, I mean, the reality is that it could have been way more destructive than it was. They could have been down longer than they were, but he had all of his ducks in a row, and he was ready for anything. And it came, in this case, it didn't even come from an employee thing. It actually came from a unprotected switch that had a 0 day that no one knew about until the exploit happened. Like, there's nothing he could have done. Everything was patched. Everything was as it should have been. And they got hit, but they were able to mitigate it. Everybody knew their job. They were able to make it not as big of a deal as it could have been. Still sucked. I'm sure it was still a horrible experience.
I want to give our listeners a quick 10-second of what a 0 day is, guys. A 0 day is something that comes out the day of. So there's really no way for us to protect against it, right? We're always playing defense. The hackers are always playing offense. I can't block something that you're writing that you're going to deploy tomorrow because I don't know what you're writing. So, we call those 0 days. They come out. As soon as they come out and we hear them, we try to come up with a patch or a defensive scheme right away. But usually they're one step ahead, right? So those do happen here and there.
At the same time, people asked me today in this meeting, well, what do we do about AI? And well, part of my answer is prepare. Like, don't be afraid of it, because some of the places where AI is really good when it comes to cybersecurity is some of the new tools that we're using to monitor viruses and to monitor behavior on machines. So there's good parts about AI, and there's going to be a battle of who's got the best, I guess, and whatnot. But definitely having a virus protection system that's robust enough to look at behavior versus just a file library is definitely a huge thing that needs to be focused on when you're looking at.
Definitely. That's something we use now as a default, right? Any type of next gen AV, we don't even use.
Yeah.
We might use a regular one on top of it or under it, but EDR next gen AV is definitely a priority.
Yeah, we're not doing the old way. The old way has reacted to an incident that's already happened versus next gen antivirus or EDR is really in the moment. Something's going on. Oh, let's stop it before we have a problem.
Yeah, someone told me we have McAfee, and I said, okay. I just said okay.
Yeah. Yeah, there was another one. Who was the one? I saw an article. Oh man, it's a prominent free one that made the news because they were actually taking information from their customers and then giving it away or reselling the data, the browsing data off. They're a really prevalent one that people were buying for, or not buying, they're getting for free. And I saw more than one business who said, "Oh, we've got whatever it was, the free antivirus." And I'm like, dude, you don't understand. Like, the antivirus does not help you at all. Like, it's just a gateway to buy their full.
Remember, if it's free, you're the product, right?
Yeah, exactly. So I think the whole point of this short segment about cybersecurity today is really about just the thinking. If a person can spend $300 to get in and begin to send out emails, this problem's only going to get worse. It's only getting worse, and we're literally seeing where it's not just hurting the MGMs of the world, but it's hurting the smaller businesses because the net is wide to cover all these different groups of people of all different sizes of business.
And that's where it really hurts, right? An MGM gets hit, they can absorb some of that blow, but what about your mom and pop shop? I've had clients before we were into the heavy cybersecurity and and those type of packages that they were part of a business email compromise, and they had to sell the business within 18 months because they couldn't absorb the loss that they had taken from the breach or the compromise.
Yeah, I know. Yeah, it's a real thing.
So, imagine working your whole life to build up your small business, and then you lose it within 18 months because like you said, somebody wanted to spend $30-$40 to see if this virus will work, and it just happened that they got lucky and it worked.
Yeah, that's crazy.
Yeah,
it's crazy, but that's why we're here, to try to help mitigate that and keep the blast radius super low and make sure people have the right things in place to protect their business.
We'll keep chugging along for it.
That's exactly what we have to do. So, well, right. I think that's it for our show today. It's kind of funny because we recorded it in two pieces. My background's completely different from what it was last time.
Mine too.
Yeah, exactly. So, but that's super great. We're going to call it for episode 17. If you find any of this interesting or helpful, please like our page on Facebook and LinkedIn. And more importantly, go over to the Apple podcast area or Spotify and follow us and like us, because that really does help us make sure that we're actually getting views. And the more of those we get, the more exposure we get. So I'm John Hansman from Washington State, and I'm grateful you're here to watch.
All right, everyone. Thank you for joining us, and we'll see you guys in our next episode.